Hello and welcome to part 2 of stock market FAQs. Today we're going to look at a few more questions, hopefully taking up lesser amount of time, but answering them at the same pace as we did last time as well. So we still have a few questions left from last video, so Kritesh and me will try to cover it as much as possible.
And if you haven't watched the last video, you can check out the link we will add in the description. Go to that video and watch that video. Along with that, we will also be publishing a lot more interesting videos on this channel, so don't forget to subscribe.
Okay, so starting off with a few questions that we missed out in the last video. So
yeah, last time it was a very good one. Let's see how it is this time.
Hopefully much more interesting as well.
Okay.
Yes, start off high itself, something a bit detailed. Can you teach me stock market lingo or stock market terms, basic terms?
Okay, so the easiest one, let's start with the easiest one. Share, stock, equity, all are basically the same thing we discussed in the last video. It basically tells you how much it costs to buy one quantity of that share. For example, if you want to buy TCS, Tata Consultancy Services, its one share is around 3200 right now. So if you want to talk about buying one share, 3200, 10 shares, 32,000. So that's what generally people mean when they talk about share or equity. Similarly, like if you want to buy MRF, so 82. Fun fact, its share price is around 82,000 per share. So that's the most expensive share in the Indian stock market. So the first important term is share, stock, equity, all means the same thing. It's the share price of the company. Second is bull. So bull are people who are optimistic about the market. Those people who wants the share price to go high. Those people think that everything is going good, the company is performing good, economy is doing good, and the share price will keep on going higher. On the other hand, there is another term called bear. So bear are pessimistic people. They want the share prices to go down. They think that the stock might not perform well in the future, and they want to sell the shares and book profit by share prices going down. So bulls and bears are another two of the most important people in the stock market, and both are required. Like if they are only bulls, there will be no transaction, no one will be willing to sell their shares. On the other hand, if they are only bears, no one will be there to buy the shares. So both bulls and bears are required to run the share market. Then comes Sensex and Nifty. So these are the barometer of stock market. It tells you like how the market is performing. So basically we discussed about this in the last video. So these are like a combination of 30 to 50 stocks in the stock market, and if majority of those stocks are performing well, then Sensex will go higher. In addition, Sensex and Nifty also tells you about the economy of a country. So basically if the barometer Sensex is going higher, it also means that the market is doing good, economy of the country is doing good. So if you see the times during like COVID, where the index declined 30-40%. So that was a bad condition for the economy, and that's why both Nifty and Sensex declined a lot. Similarly to during 2008 crisis, economic crisis, at that time also both these indicators, Sensex and Nifty, declined by around 60%.
They crashed.
They crashed. So basically if they are consistently growing 8 to 10%, 12%, we can see that the economy is doing very good. But if they are crashing, bear market, then we can show that economy is slowing down. Currently you can see that the US indexes, Dow Jones or Nasdaq, both are going down. They are going through a very bad time. The inflation is all-time high and all. So their barometer also, Dow Jones index or Nasdaq, is reflecting the same. So the third more important thing was this Sensex and Nifty. Apart from that, few more important things is required is like demat account, trading account. So if you want to do day-to-day trading, then you will require a trading account. And if you are doing a long-term investment, if you want to buy and store the shares, then you need to keep it in the demat account. It is same like a saving account where you keep all your shares. So both trading and demat account is all together opened in India in most of the brokers. And some of the big bank brokers, they also offer 3-in-1 account, like banking account plus demat account plus trading account, all together can be opened at one. So demat and trading is again one of the most important terms that people should know. And finally comes brokers or stock brokers. So the thing is like you cannot directly buy and sell shares from NSE or BSE. You need an intermediary party who will take care of all the things. So if stockbrokers are those people who facilitates trading and or investing in stock market, they will provide you with the a very good UI, very good app, and using those you can buy shares, you can sell shares just by sitting on your couch.
Yeah.
So stockbrokers are another important concept that people should know.
Okay. We spoke about MRF.
Yeah.
That brings up another question. What makes some shares very expensive and what makes them affordable?
Okay, the thing is like, although MRF is very high, like let's say
Phenomenally high.
82,000. The thing is, there's two concepts. There's a concept of market capitalization. So market capitalization basically tells you how big the company is. So it is the multiple of the share price into the number of outstanding shares, how many shares are there. So although MRF has 80,000 per share, but the total number of shares are very less. Comparatively, let's say in the case of ITC or Reliance, like their ITC share price is around 320,
Yeah.
and Reliance is also like 2500. But the quantity is very good. They have like crores of shares, and MRF has very limited number of shares. Just by looking into share price, you cannot say it's overpriced or underpriced. You will always find ITC underpriced if you compare just the share price with MRF.
82,000 was 320 rupees.
But the share price doesn't say anything. What I want to say is like share price may be very high, but it doesn't reflect the valuation of the company. For the valuation, you have to look into a lot more compared to its historical price, how much is trading, compared to its competitor P ratio, price to earnings, how much is doing. And if you want to do complex valuation, you can also go into DCF, discounted cash flow, and all that. But those are kind of like expert thing. But
Next videos.
yeah, but we will try to explain those to our audience in the upcoming videos.
Yeah. This brings up another point. People can learn about stock split through this example. What exactly is a stock split?
Okay, so the thing is like one share of MRF is 82,000. So normal retail investor, normal people cannot invest in those shares. So a lot of time companies do not want normal people to invest in their shares. They want to be exclusive. They want their shares to be like, they do not want people to gamble on those shares. So they keep the share prices very high. 82,000, people cannot trade, day trading and gambling is not possible. But if they want to make it affordable to all the people, so what they can do, they can just split the share price into different parts and give those shares to the people. So let's say if MRF want to make it affordable, they can do a stock split of 1:10. So in that, every person who is having one share will get 10 shares, but the share price will reduce from 82,000 to 8,200. So this is also a way, like a lot of time when the share price goes up very high, company decides to make it affordable to the people by doing the stock split. So here nothing is changing. All the fundamentals are same, the depth of the company, the profitability of some company, everything is same. Just they make it reduce the share price of the company by splitting it into different parts.
So more people end up buying.
More people, it becomes a lot affordable for people to get into those ones.
So yeah. Simple. This is pretty straight on to the point. How long does it take to buy or sell a share?
Okay, generally you can buy shares like it's done. So if you have a demat or trading account with any of the renowned broker in India, stock buying or selling doesn't take any second. You just have to select the name of the share, let's say HDFC Bank, how much quantity you want to buy, 1 share, 10 share, 100 share, 1000 shares, and at what price you want to buy. So you just have to enter these things and you have to click on buy button, and in a second you will be buying that shares. Settlement will take 2 days. So basically if you are buying a share, there will be someone else from whom you will be buying. So from his demat account transferring to your demat account, it will take 3 plus 2 days, 2 days to settle. But basically it will be done in a second.
Yeah, but ownership is of course declared then, and that you hold the positions.
Yeah, right. Ownership, changing all the things from one demat to secondary demat, all those processes will take T plus 2 days time.
To reflect, it will take.
But the moment you place the buy button, it is bought in your demat account.
The shares are yours.
The shares are yours. Similarly, in the case of selling also, you can sell in a share in a second, but it will take some time for the money to get back into your trading account.
Yes, this is a very good question. So we often hear reports about brokerage firms giving out buy orders on this share. They expect the price to go at this point in like 1 year time or 2 year time. So should I listen to the news and buy stocks based on the recommendations, or should I follow ace investors like the late Rakesh Jhunjhunwala?
Okay, so for your first question, should we invest based on the news and all?
Yes.
Obviously, we have to follow the news. There are a lot of things happening in the stock market, a lot of things happening with the company. So you should always know what exactly happening with that. But a lot of times, based on short term news and all, you should not invest. Like we discussed the case of Brahmastra, the shares of INX and PVR, they declined 5% just because Brahmas didn't perform. But that's a short term thing. A lot of movies will come in future and a lot of profitability will increase. So if you're investing for long term, these doesn't make much sense, but do follow the news, know what's happening in the stock market, what's happening with the company and all. Now coming with the brokerage firms, so do you listen to brokerage firms? So do you listen to their buy and sell calls? The first thing is like they have a lot of resources, they have a lot of exposure, they have a lot of experienced people working in their team. So these people have a lot of experience, they have a lot of data, they have access to a lot of refined news and all. So a lot of time they will have a lot more information compared to the retail investors. So sometimes they obviously look into good, they obviously give good recommendations to buy and sell. But the problem comes is like it's their job to give buy and sell calls.
Okay.
So let's say today, even if there is nothing good to recommend, nothing is happening in the market, even in the whole month, nothing is happening, they have to recommend some stock.
Yeah.
So obviously they will end up giving you any random thing that they found or anything like which might not have very big potential and all. So we have to stay away from those ones who are continuously giving you recommendations. And second is like a lot of time if you are going through it, go for the firms, paid firms and all who take you as a client. Like they will want to perform well because you are their client, you have taken money from them, and their income depends on how good performance they are providing. A lot of portfolio management services are there, big services are there which provide recommendation. But the free ones who are not making any penny from the audience, which is just doing their job, they don't care much about whether you win money or lose money and all. So their hit ratio is also very low. So do not, just maybe if you are a new beginner and all, you can look into what they are saying, but do not blindly invest on what they are saying.
And also why they're saying it. That's
why they are saying. A lot of time they will just write bullshit in their reports and all, which will be very difficult to comprehend for the beginners and all. But it's their job, so they have to provide the recommendations.
And they'll also end up using terms that you will not be able to understand.
They actually want that one. A lot of time if you're reading the reports, only people focus on what is the target price.
It'll be in caps. BUY. Buy.
Buy at 390. Apart from that, everything you cannot understand what they're explaining.
So yeah, and also at the end of each report, you always have the disclaimer. Subject to market volatility.
Subject to market volatility, and we are not liable for the losses that you are incurring.
So yeah, just be careful.
So basically do not listen much to them, do your own independent research. It will always give you better result. Generally market is not going anywhere, it's going to stay the same place. And just if you are able to learn how to invest, how to pick stocks, maybe even if it takes 2 to 3 years, you can use your learnings for the next 20 to 30 years to find good stocks. Don't be in a hurry to pick good stocks. Take your time as long as you take. But do not think that don't fall into FOMO, fear of missing out, that market is going higher, I have to buy on any recommendation that you get. Market is not going to go anywhere, it's going to stay. Take your time.
And the markets will forever exist.
Market is forever.
Speaking about independent research, we have something new coming up that's going to launch in a very short span of time, which will help you do that independent research, unbiased, clean, and completely reimagined. So
stay tuned to our channel and hit the bell icon.
We're not going to reveal what it is right now.
We'll be revealing very soon on this channel.
Yes. Okay, very interesting. This is a little bit into the intermediate level, but I'm sure people still have that curiosity. Since we consider shares or securities as assets, and normal assets such as gold and real estate allow you to take a loan against these assets, can I get a loan against shares as well?
Most of the big brokers, Zerodha, HDFC and all, they allow you to pledge the shares to take a margin against it. So let's say if you have shares worth rupees 2 lakh, they will do a haircut. So let's say they will allow you to pledge 80% of it and 20% to keep it there. So let's say you pledge 80% of that one, you can use 1.6 lakh as a margin. So using this margin, you can trade in stocks, you can trade in derivatives, make profits and all. So pledging is allowed for most of the brokers. It depends on also on what shares you are holding. For some shares the haircut is very much, and for some stock it is as low as 10%. So if you have shares worth 1 lakh, you can place it in your account, take 90,000 as a margin and play around to buy and sell shares.
If you learned trading properly.
If you learn trading properly. But you cannot use the same margin to buy more shares.
Yes. People would get confused.
It can only be used for intraday derivatives and all. You cannot buy more shares by placing again and again. So yeah.
Going back from losing money in the market, I mean about like being irresponsible in the market, can people lose money in the stock market?
Well, obviously, we have seen majority of the people who enter the stock market lose money in the stock market. But the same goes for any other thing that you are doing. Majority of the people don't get into IPL or play for the cricket team. 99% fail. Majority of the people don't do very good in the academics, they fail. So almost 90% of the people fail, but they fail in everything. Only 10% people are successful. Same is in the case of stock market also. Let's say 10% of the people make money, rest 90% people lose. There are a lot of reasons why people lose money in stock market. One of the most common is like not doing any research. They will just hear any stock recommendation, like we discussed, brokerage firm or their friends or anyone else, and they will buy that shares without doing any research, without even knowing like what the company's product is, what services they are providing and all. And here it's just a gamble. You're just betting on something that you have heard, but you don't know anything. There's no analysis behind. So here, if you are doing that one, majority of the chances is that you are going to lose money. But on the other cases, there are people who have made a lot of money, consistent money from the stock market. They do not take they don't want to double their money in 3 months or 6 months. They want consistent return. So here, those people who have realistic expectation, like they just want good 15-20% returns, they are not very greedy, they are able to make very good returns. However, the people who just want to take blindly bet on anything, those are the people who fail in the stock market.
So like if you buy a stock and if somebody asks you why you bought that stock, your answer cannot be because this person told me.
Your answer cannot this be also that because the share price is going higher. It can stop going higher at any point and you will not be able to give reason. So just because the share price is going high or just because share price is going low, it's not the reason to buy or sell a share. There are a lot of factors involved in behind that you need to answer, and you have to answer why you are buying, why you are selling.
Clear cut. Very interesting. So of course there's this gets into passive investing and active investing. So speaking about, I'll let you explain what passive and active investing is before we get to this next question.
Okay, so active investing is basically doing your own investments where you are looking into where you are buying, where you are selling, managing everything on your own. Passive investing there are a lot of ways of how we describe passive investing, but simple way of to describe is like you are not directly involved. You are just paying the money maybe to someone else or some different sources, and through which you are not giving a lot of time in that one. So that is the difference between active and passive investing.
So the reason I asked Videsh to answer this was because the next question is, mutual fund and stock market, are they the same?
First thing is like a lot of people listen into that mutual fund disclaimer that they are giving that it is subject to market risk and all. It is because mutual fund invest a lot of money in the stock market, but it's not necessary that mutual fund only invest in the stock market. So when you're investing in stock market, it's just direct stocks, direct equities. But in mutual fund, you can also invest in debt funds like FDs, bonds and all. You can also invest in gold. So there are a lot real estate REITs are also there. So there the options are varied. The bracket can be distributed. There's equity based mutual funds who invest majority of their shares in equities. There is debt based mutual funds who may invest majority in the debt. There is a balanced mutual fund, and there are different ways of mutual fund there also. So both are not the same, they are different, and the way how you invest is also different. If you are investing in stock market, you are making your own decision. You are deciding where to buy, where to sell. And in the mutual fund, there is a fund manager, there is a person in suit who will decide where your money will go. So that is also different. Here you are actively managing, there you are kind of passively managing your funds.
So that clears it, mutual fund.
But both of them are risky because a lot of money, if you are investing in equity funds, it will go in the stock market, and as you know, stock market is volatile based on the market movement. It can go up or high or low.
Yeah, so a few more questions. Yeah, okay, very interesting. Finally getting to the point that we wanted to talk to you about. Where can I learn if I'm interested in the stock market?
Okay, if I tell you my story, when I started learning about stock market during my college, I have literally watched all the videos available on YouTube. So anything, there wasn't any big YouTuber or anyone whom I didn't knew. So I have watched almost everything available. Blogs and all also I used to read, but I was not very kind of like very enthusiastic about reading vlogs and all. First of all, easiest way is like follow YouTube channel. Like if you can follow Trade Brains, you will learn a lot. Apart from that, there are a lot of YouTubers available who will teach you stock market, investing and trading from basics. So that is the easiest way, but it is a lot of time taking. Like I said, in my case, I was in college, I had a lot of time. I can spend years, I can spend 8 to 10 hours in a day. If you are a lot of busy people, if you don't have much time, if you are doing a job along with that, you want to learn, it's better to do some courses and all. There are a lot of good courses available. If you're planning to invest 1 lakh in the stock market, you can buy courses for 2 to 3,000, even 5,000. A loss of 5,000 is better than losing 1 lakh in the share market. So that is buying courses and all is also a very good option for the stock market enthusiasts, who are those who are very busy people. Apart from that, there are also different ways, like a lot of good books are available in the stock market which are written based on stock market. Peter Lynch books are there, who are one of my favorites. One Upon the Wall Street, Beating the Street. These are kind of good one. Slightly advanced level, there is The Intelligent Investor by Benjamin Graham. So there are also a lot of books based on by Indian authors, foreign authors that you can learn. And apart from that, you can always go to FinGrad. So just to give you a little more, FinGrad is our financial learning initiative. Here we provide more than 60 courses and webinar about everything that you want to learn about finance, from taxes to investing to trading. For everything, the courses are available, which are made by the market experts. So do check it out, and there you can definitely find something very interesting that can boost your knowledge.
So you'll not be paying for one course in particular, but you'll be getting the whole bundle under like one subscription model. So you can check it out.
Link is in the description.
Coming on to the last question here. Where can I practice investing?
Okay, there are a lot of ways how you can create dummy portfolio. So like if you're planning to invest anything, for research you have to do your independent research. So there are different websites, like we also have TradeMan's portal where you can go and look into the fundamentals of the company. So that you have to do yourself, research basically where you want to invest. But after that you can do paper trading or paper investing. So paper investing basically means that you are investing virtual money, but you are not putting your real money in that one. So there are a lot of ways. Even in our app, TradeMan's app, you can create your portfolio. Let's say you want to buy 10 shares. You can just create a dummy portfolio, buy those 10 shares at a specific price, at a specific quantity, and you can track how you are performing, whether your the research that you have done, whether all the things that we are thinking went right or wrong. So just add all the stocks in a portfolio, watch it for 1 month, 2 months, 3 months, see how whether your portfolio is going high or low, whether your conviction was right or wrong, and based on that you will also get confidence. You will also learn ki ha, my whatever research that I have done was correct or wrong, and slowly after that you can maybe start investing small amount in the stock market. So initially start with paper trading, virtual trading. After 3 to 6 months, start investing real money, that too with a small amount.
Nothing too significant that you'd feel bad if you lost when you actually start. Yeah.
The thing is, like when you're doing virtual money, you do not feel too bad when you lost,
Because it's not real money.
but you will feel a lot bad if your portfolio went too high. But there are also beginner luck. A lot of people fall into beginner luck trap. They invested in some amount, it went up, and they start thinking like it's very easy.
Yeah, I know everything now, that type of attitude. Yeah.
But slowly after 6 to 12 months you will start learning that no, this is not easy. It takes a lot of skill and a time to learn about that thing.
Okay, yeah, that's the final question for part 2 of stock market FAQs. We hope you like this video as well. So the link in the description will detail exactly what we've been talking about. So go and check it out as well.
Okay, and we will be coming up with lot more interesting videos on stock market in the upcoming days. So don't forget to subscribe our channel and do comment below if you have any other questions that we didn't answer,
So that we can add them to the next video as well.
okay.
Thank you.
Thank you so much.